Hello, welcome to Smart Investing Market Insights on TFNFinancialNews.com. I'm Krista Das. It was 2001 when Fannie Mae announced that the U.S. housing market should continue its strong performance through 2001 as the economy rebounded and long-term interest rates stayed low. New home sales at the time were expected to climb to a record 889,000 units in 2001, beating the record for new homes sales of 885,000 units set in 1998. Sales of existing homes had just risen in May to a bigger than expected gain that pointed to ongoing strength in the housing market. It was one of the bright spots in the sluggish U.S. economy. My next guest, Death Cross Trader editor Ian Cooper, should know. In 2001, he was long most home builders, but began reversing course in late 2006 and early 2007 as the housing market turned grim. Ian, welcome.
Thanks for having me, Krista.
In February 2007, you called the top of the subprime lenders and even called for New Century Financial to head to bankruptcy. What was it that tipped you off and led you to issue your short recommendations?
Well, at the time, even to us, mortgages were the one area of subprime where we saw something that looked like a recession. You know, Lennar, KB Home, D.R. Horton didn't see the bottom that the likes of Hank Paulson were calling for. Home sales and prices were pulling back. Delinquencies and defaults continued to spike. We also knew that 2.2 million borrowers could at any time lose their homes and up to $164 billion of wealth in the process. The writing was on the wall for further downside. We called for New Century to head to bankruptcy, which it did. We called for subprime and Alt-A loans to stumble, and they did. When all was said and done, we helped readers realize between 34% and 214% gains on New Century, 59% to 291% gains on Fremont, between 83% and 108% gains on Countrywide, and another 103% to 364 gains on Accredited Home.
Impressive gains, Ian. Before we get into opportunities you're looking at now, I want to ask this. According to Hank Paulson, we're at or near a bottom of housing, and according to other officials, there have been no spillovers to the greater economy. Does that change your housing downside prediction in any way?
No, absolutely not. Hank Paulson has said we're at or near a bottom many times before. He's wrong again. As for the lack of spillover, every time I hear that there's no spillover from housing, I cringe. Listen, I've long held the view that housing won't show signs of recovery until 08 or 09, with worst case estimates pushing that back another year. But those estimates are still dependent on what will happen when an estimated $1.1 to $1.5 trillion in ARM mortgages face resets this year, costing the average homeowner an extra $200 to $250 a month on a $200,000 mortgage, for example. But it's just not the home builders and lenders who are facing sharp sell-offs on the everlasting fiasco. Auto companies, too, are facing big downside risk. Just take a look at AutoNation's reaction to the housing slump from $23 to $19 in recent weeks. It also came as no surprise that July U.S. auto sales fell thanks to fewer discounts and the effects of a weakening housing market, according to reports. Numbers were so bad that the big three only managed to account for 50% of total U.S. auto sales as compared to a mid-80s peak of 77%. General Motors sales fell 19%, Ford sales were down 17%, and Chrysler Watches shares fell 8%.
Ian, you obviously see further downside for the housing and lending. When can we expect relief or a bottom to the housing fiasco?
Well, let me begin by saying that it won't be the Fed that's coming to the rescue. In my opinion, the Fed won't cut near-term Fed fund rates to help housing. By doing so, the Fed would send a weakening dollar message throughout the world and raise inflationary pressures. As long as consumer spending isn't affected, and as long as the Fed perceives that the economy is okay, we won't see rate cuts. As for housing, Death Cross Trader has had recent triple-digit successes with its plays on Accredited Home, IndyMac, Hovnanian, Standard Pacific, Toll Brothers, Lennar, and Centex. We're just now in the finishing stages of our half a dirty dozen report for readers, detailing 6 more overvalued stocks with falling knife formations piercing major multi-year support levels. One of those is MBIA Incorporated, MBI, where a break under 50 sent it to $40 near term.
I also just read that you see the Dow hitting 12,400 by November 1st, 2007. Why is that?
Well, consider this. Hefty multi-billion-dollar funds are unraveling. 2 Bear Stearns funds with heavy exposure to mortgage just filed for bankruptcy protection 2 weeks ago after telling investors that one of them was worthless and that the other had lost 90% of value. Investment banks are tumbling. Foreclosures are up more than 50% year to date. Home builder confidence is low. Housing prices are coming down. Credit is deteriorating. Plus, says the New York Times, the peak month for mortgage resets happens this October '07. That's when $50 billion of mortgages will reset at higher rates. After that, says the report, about $30 billion worth of mortgages will reset every month until September '08. When all is said and done, we could watch as $1 trillion worth of mortgages reset. Now imagine what will happen to cash-strapped homeowners with risky mortgages face high resets. Some will do okay, others will cut back on spending, others, including an estimated 3.2 million homeowners, could face the risk of delinquency and foreclosure. That's just one card pulled from the bottom of housing's deck. The next one pulled could hurt even more when those foreclosed homes flood the market and depress housing prices even further. You can argue that economic strength outweighs housing weakness, but there's too much uncertainty to bet on a big Dow recovery. Over the last 10 years, there has not been a housing bubble like this one. With so many mortgages about to reset, there are a lot of scared market participants heading into October '07 resets.
Great information, Ian. We look forward to that half a dirty dozen report. As you know, Ian has a knack for finding overvalued companies riding high on herd mentality. He is currently up 234% on a Centex home builder put. And as he's said earlier, he believes Centex could retest 2003 lows of about $20. If you want to read about more exciting and highly profitable investments, simply click on the screen or go to TFN. Again, I'm Krista Das. Have a profitable week.